It is a Fed-focused week as we begin what will be almost the first full week of trading back from the holidays. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we have the opportunity for what could be a key rethink around the markets, providing a significant impetus for trend change around these financial markets. As we look at what comes next, we're going to explore it all here as we break down the event risk that follows. I say it is almost a full week because we, of course, have a closure in these markets on Thursday for the funeral of former U.S. President Jimmy Carter. But nevertheless, it is a U.S.-focused week. So what we'll do here is break down what happened last week, which, not surprisingly, isn't a whole lot, but it is important stage setting, and then consider how we got to where we are over the course of the recent months, how the stage is set then for this week's event risk, and what trades may follow once those bits of information cross the wires. So consider here last week's performance. Stocks and bonds a little bit cooler. S&P 500 off 0.6%. The NASDAQ only a tad worse off, 0.8%, but clearly no major changes in their positioning from those moves, just some mild shuffling around within the ranges. The bond market, not dissimilar in this sense. Yields coming in just a bit. So bonds themselves holding at the swing lows as the markets went off on holidays. Not a lot of things to say there. Needless, the sort of macro backdrop, the data flow was very, very light. The participation relatively thin across global markets, not just in the U.S. So the level of speculation, needless to say, diminished, as it were, and the amount of conviction sparse. The standout, really, crude oil, which continues to march to the beat of its own drum with a rise of 4.8%, but otherwise not a whole lot going on. The 4.1% rise in Bitcoin isn't really a big jump for that market and its outsized volatility. So on the whole, things looking relatively staid. Gold oscillating, the US dollar oscillating. So very little to go on, but that does not mean that this week has a similar character to it. And in understanding sort of where the volatility might come from, the jump off that makes sense is that of the evolution of Fed policy expectations in the fourth quarter, because that seemed to have really defined much of what happened in the broader sort of macro narrative. And here we can see that between the Fed's quarterly update of policy expectations in September and the subsequent one in December, there was a dramatically hawkish shift in expectations. So now we are expecting to finish this year with interest rates at around 4%, whereas in September, the terminal rate looked more like 2.8. In other words, we have moved in excess of 100 basis points in a hawkish direction by the end of this year. Now, of course, the slope of all of these lines remains down, so we're still expecting rate cuts, but as ever, the markets move in relative terms and price things in relative terms. So what we've seen over the fourth quarter was the markets taking the Fed's dovish messaging in September and saying, right, that's too dovish. Now we are going to take what you've said and imply that you're not going to do it in full because the economy is not going to let you. Inflation will be too hot with both an economy that's relatively strong and a central bank that, as of September, already began an easing cycle. And indeed, we can see that right here. So with this in mind, we, of course, get significant readjustment across markets from September already by November. And you can see that here. The curve for the Fed's meeting on November the 7th, before it adjusts forecasts, is very similar already to what then ends up being the revision in December. The market's already made that adjustment, and indeed we are very much in a similar sort of space now. So from November onward, these curves are very clustered, and you can see that occur here. So the markets from mid-September through to early November bid up inflation expectations. At the top here are break-even rates implied in bond markets, which speak to the market's inflation expectations. At the same time, the yield curve steepens. This is the 2 to 10 year spread. The dollar rises because, of course, that adjustment makes yields on the dollar more attractive relative to other currencies. And, of course, the yields themselves go up. So here we have the 10 and the 2 year showing a spirited advance. So we see clearly that there was an adjustment in the way that the markets perceived policy once the Fed made its announcement, and the dovishness of September really looked overdone, even as, by the way, the markets themselves called for that dovishness. Consider what was going on here from May through September. Yields were coming down. Inflation expectations were coming down. The dollar was coming down. So the markets were looking for the Fed to kick off an easing cycle. It's just when they did, and when the Fed issued its prognostications, the markets decided that for where the economy stood then, it was too far, too fast. Now, we can see the implications here. This is the outlook for monetary policy this year and next. And we can very clearly see that we've gone from a cumulative 138 basis points in rate cuts over this year and next that were baked into Fed funds futures to just 60 now. Barely that. And indeed, while the Fed in December was saying that it will now look to cut 50 basis points this year, the markets are barely at 40. And for next year, there's only one cut almost priced in. So the way you even get to this, which is essentially a halving, even a little bit more, of this outlook, further speaks to the amount of readjustment that the markets have made in a hawkish direction. The Fed, of course, already delivered 100 basis points in easing last year as it foretold, but the next steps in this equation look like they're now very much tilted toward slow-going, dribbling out of stimulus over a longer period of time versus what the Fed said in September, which is that 100 basis points more in cuts are on the menu for 2025. Now, in fairness, the U.S. economy is in fact very strong. If we take a look at what we have here from the latest set of PMI numbers, we can see a booming service sector is lifting overall U.S. economic activity to some of the strongest levels that we've seen since back here early in the cool down from the post-COVID adjustment. We can see here, of course, as 2021 kicked off and the COVID restrictions that were there, as well as the pessimism around the pandemic, as that started to give way, both with the rolling out of vaccines and the scaling back of some of the restrictions, we saw a swimmingly sharp rise in growth because, of course, the economy had to catch up from being essentially turned off for the most part. And once that peaked, we saw the economy kind of cooling back to normal. As ever, the way that we read these figures, these PMI numbers, is with a 50 being neutral, neither growth nor contraction. Above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so what we find here is as we start to cool down from that run-up in the pace of growth to catch up following COVID closures, we briefly have a period of contraction in 2022, especially as the Fed really starts to hike rates, and then we start to normalize. And having carved out this sort of range in 2023 sort of first half into 2024 first half, in the second half of last year, we really pick up steam. And so the pace of expansion of economic activity, looking at both services and manufacturing together, but of course, we can see here clearly powered by the service sector, we get all the way back here, something along the lines of a 3-year high. So the strength in the U.S. economy is undeniable. Nevertheless, we take a look at the way that economic data has performed relative to forecasts, we find a very similar story here after the December meeting of the Fed and that hawkish readjustment that we've just witnessed, as we did in September, except the other way around. So here is where the Fed's meeting in September falls on this Citigroup U.S. Economic Surprise Index that measures not the absolute strength or weakness of the economy, but the degree to which U.S. economic data is surprising above or below expectations. We see here, of course, that from mid-April or so, the U.S. economy is showing signs of cooling. U.S. economic data is weakening relative to forecasts, which is why, as the Fed is resistant to cut rates in this period, we see the markets go, no, you're going to need to cut. And things get increasingly more dovish. We likewise see that when the Fed actually makes the move, right here, they cut by 50 basis points. They say they're going to cut by 50 basis points more, which they subsequently do. What happens is actually a move in the opposite direction. Fewer cuts are being expected. Yields are going higher. The dollar is going higher. And that is because by the time the Fed does this, it's mid-September. And by mid-September, U.S. economic data has already started to improve relative to forecasts as of late August. And all of this improvement then beckons the Fed to be more hawkish in December. But by then, again, by mid-November or so, data has already started to cool. That December Fed meeting is around here. And so now we potentially run into the risk that the Fed has overstretched to the other side of the equation. And so with that in mind, perhaps some of this is now vulnerable to a reversal in this direction, much as it was this that marked overly dovish signaling in the preceding quarter. So, what does that look like as we move forward through this week? Well, the first bit of event risk where this thesis is going to get tested will be the ISM Service Sector survey. This is from the Institute of Supply Management. It is a great indicator of economic growth dynamics. And here we're expecting that after the 3-month down tick on November's numbers, that in December, activity in the service sector will firm a bit. We got a slightly better than expected number on the manufacturing side of this story last week. Still a contraction. Again, as with the PMIs, this works around a center line at 50. And here, not quite as bad as expected. So 48.4 expected, 49.3 actual. So manufacturing shrank at a slower rate than anticipated. We'll see if the service sector holds up, because, of course, that's where the action has been, as the S&P Global version of the numbers tells us. Manufacturing has basically been in a narrow range. It's the service sector that really determines where the economy is going here, and that will be the interesting bit. If this starts to reflect what we're seeing here, that is to say, data has cooled to a point where it might start to miss relative to forecasts, we might get the sense that indeed yields have gone too far. The dollar has rallied ahead of its reasonable levels, and bonds have gotten too cheap. And if this number is then weaker than anticipated, you could see that start to reflect in a bit of a repositioning. The next interesting bit, and perhaps the highlight for this week, will be minutes from that December meeting. Now, this is an editorialized document. It's not exactly a stenographer's word-for-word account. And so the Fed is going to be able to massage its messaging, obviously with full knowledge that the markets are going to read it as some sort of guidance light. And so it'll be really interesting to see if this hawkish rethink that the Fed unveiled in December looks as entrenched as it appeared. Consider here the outlook. So the Fed delivered on the 100 basis points for 2024, as we've just alluded to, that it was signaling. But for this year, the calculus changed significantly. So the 3.4% Fed funds rate that was expected in September to be the terminal point for this year now is the terminal endpoint for 2026. So the Fed said, we thought we were going to do 100 basis points in cuts. We're now only going to do 50, and we are going to extend the time in which all of these moves arrive. So that whereas before we thought we were going to end up at 2.9% by 2026, we're not even going to get there by 2027. So less rate cuts, and those rate cuts will be more spaced out. If the minutes suggest, as some Fed speechifying has implied, including from Jay Powell himself, going into and shortly after this meeting, that the Fed needs to get less jumpy around economic data, needs to embrace that economic data has been volatile and look through it more, then we get the sense that the Fed is going to be not only more hawkish, as reflected here, but also reluctant to get off that perch unless data really screams very, very loudly that they need to get more dovish again, lest they jump into another dovish pivot like in September and end up looking wrong. Then the markets might look and say, well, if the Fed is reluctant to ease and the data is cooling, well, then markets really are off sides. And another readjustment needs to happen, much as we saw in September, but in the opposite direction. We're going to have to beckon the Fed to make a shift. Again, implying that just like this looked overdone and needed a correction, this might now be and is in need of a pull in the opposite direction. So the degree to which the Fed appears on hawkish autopilot and reluctant to change course, and again, of course, relative hawkish autopilot, we're still looking at cuts, just far fewer of them. The extent to which the Fed seems reluctant to change its mind in a hurry on that view might be very impactful for markets. And of course, the key there also will be the response from stocks. If stocks extrapolate from this a growth concern and decide to turn lower because they feel the Fed is not going to be responsive enough in the face of an economic readjustment, not necessarily toward a recession, but just a cooler pace of growth, then cyclical inspired risk aversion may follow. And it may not be just that the dollar cools and yields cool and bonds come up. That bond move might get some amplification if there is a cyclical concern that comes alongside and there starts to be risk capital coming out of equities around worries about what a growth scare could look like. Finally, rounding out the week, there is the U.S. jobs report. We're looking for 160,000 to be added to non-farm payrolls. The jobless rate seen holding unchanged at a 3-month high of 4.2% that it reached in November. And again, as with the ISM numbers, the risk here is that this is the new regime. That U.S. economic data has started to tilt slightly in the direction of underperformance relative to forecasts, and that against this backdrop, even these modest forecasts might be too rosy, in which case, if there is disappointment, then yields have room to cool, as does the dollar, and those cyclical concerns that might strike stocks with the FOMC minutes, they would get some more confirmation. And that is macro money for today. As ever, we are back to our regular scheduling Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may head therefrom. I am this year joining Victor Jones on Tuesdays rather than Wednesdays for the Price of Truth. I'm likewise on with Chris for Futures Power Hour Mondays and Fridays, on with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. Happy trading. Macro Money's back tomorrow. If you're watching on YouTube, don't forget to like and subscribe.